Hello and welcome to our first quarter 2022 Market Insights video. Similar to the other videos in this series, we will spend the majority of our time talking about what happened over the previous quarter in the markets, as well as what to anticipate for the remainder of the year. My name is Greg Leonberger, and I'm the Director of Research here at Marquette Associates. For contents, we will follow the usual script that we do in this video series. We will start with an overview of the markets and talk about the U.S. economy, since that is the natural backdrop to capital markets. We will then move to the traditional asset classes of fixed income, U.S. equities, and non-U.S. equities. And finally, a section on alternative asset classes consisting of hedge funds, real estate, infrastructure, private equity, and private credit. As always, the contact information for each analyst is on the section divider, so please feel free to reach out to any of them with questions you have about that section. An overview of the first quarter of 2022 indicates that commodities continue to outperform as the overwhelming leading return resource in capital markets. Every other asset class was negative as a result of increased interest rates, worries about inflation, worries about Fed tapering, and concerns over the impact and longevity of the Russia-Ukraine crisis. We are hopeful that the remainder of the year brings better news for the capital markets, from fixed income to U.S. equities to non-U.S. equities and other alternative asset classes. However, there are many themes and concerns which we have for the remainder of the year. In particular, the most commonly cited themes and risks for the market for the remainder of 2022 are listed on this page here. Decades high inflation, Fed efforts to combat inflation via high interest rates and tapering, and then of course the Russia-Ukraine crisis are all concerns for the future returns this year. However, we do see improved stock selection opportunities for active managers at hedge funds because of divergent returns across different sectors of the market. As we said before, inflation is a legitimate concern for the short term, but there are many asset classes, particularly in the alternative space, which can mitigate the negative impacts of inflation on portfolios. Because rates are low, expected to rise further in 2022, we do think there are limited opportunities in most sectors of the fixed income market. Our highlights of the U.S. economy largely mirror the risks already articulated on previous pages. Inflation worsened again in March, with headline CPI up 8.5%, and core CPI, which excludes food and energy, up 6.5%. However, most analysts suggest that inflation has now peaked and will start to drop from this point forward. In response to mounting inflation, the Fed raised rates 25 basis points in March. It is expected to raise rates 50 basis points in May and 50 basis points in June. Consumers are increasingly worried about the economy falling into a recession. This could be a potential headwind for economic growth, as fears about a recession cause consumers to spend less. Last, the BA.2 variant has emerged as the dominant COVID strain in the U.S. The reported cases remain low relative to the Omicron peak earlier this year.
Hello, this is Frank Valley, Senior Fixed Income Research Analyst. The first quarter of 2022 was not good for fixed income investments. The Bloomberg aggregate experienced a negative 5.93% return as the Fed moved the Fed funds rate from zero. The two-year note moved from 74 basis points to 2.34%, and credit spreads widened. The last time fixed income returns were this poor was in the early 1980s. The similarities of that period to the current period are eerily similar. The Fed pursued an aggressive rate policy to fight inflation. Fed funds rates moved from 13.78% to 19.1%. The two-year note rose from 11.2% to 16.7%. These policies did have their desired effect. Inflation fell from 13.7% to below 4%. The 10-year note is the benchmark note for Treasury rates. It is more market-driven than policy-driven. The yield on the 10-year note moved from 1.63% to 2.32% in the first quarter as inflation concerns grow. The nominal yield curve flattened during the quarter. The policy-sensitive front end rose more than the back end. The market is currently pricing in a 50 basis basis point move in May. By the end of the year, it expects the Fed to hike more than 8 times to create a Fed funds rate of 2.4%, which would be near neutral. While nominal yield curves have inverted, real yield curves remain upward sloping. This warrants caution, but a recession shouldn't be viewed as imminent. However, rising real yields are making risk assets less attractive. Historically, the direction of interest rates and credit spreads have an inverse relationship. Post-COVID crisis, this relationship has broken down. The Fed injected liquidity into the market, driving rates lower and spreads tighter, the so-called Goldilocks scenario. As the Fed has withdrawn liquidity, the correlations remain elevated, with the reverse occurring. Rates are moving higher and spreads are moving wider as lower risk assets become less attractive, with treasuries exhibiting positive real rates.
Hi, I'm Colleen Flannery, and I will be reviewing the U.S. equities section of this presentation. The first quarter of 2022 represented a change of pace for U.S. equity markets. The S&P 500 notched its first negative quarter in 2 years, and mid and small cap stocks sold off in tandem with their larger peers. The difficulties experienced by U.S. equities to begin the year were driven by a myriad of factors, including an increasingly hawkish Federal Reserve, inflation that remains elevated, and the outbreak of war between Russia and Ukraine. In this section of the presentation, we will be detailing how these factors have impacted U.S. equities on a year-to-date basis through the lens of valuation and volatility, among others, while attempting to shed light on future risks and opportunities within the space. Large cap equities outperformed their smaller peers on both a year-to-date basis and in March, while style leadership was pervasive across the market capitalization spectrum. Specifically, growth stocks trailed their value counterparts on the domestic side, likely in part due to investor beliefs that a higher interest rate environment could be a headwind for long-duration growth assets and a tailwind for interest rate-sensitive value stocks. This dynamic had already existed down the market cap spectrum prior to the quarter, as the Russell 2000 Growth Index underperformed its value counterpart by 25% in 2021, the second largest calendar year spread in the history of the Russell indices. Energy and defensive sectors of the S&P 500 have notched the strongest year-to-date performance to this point. Exploration and production companies, as well as energy services businesses, have returned upwards of 39% since the start of the year, and have largely benefited from crude oil prices surging to a nearly 8-year high during the quarter. It remains to be seen how sustainable these gains are, given the high correlation of sector performance to commodity prices, which may be reaching a peak. Defensive areas of the market, like utilities and consumer staples, which have also performed well in the year, tend to be favored during periods of uncertainty given their high dividend yields and inelastic consumer demand for their products. If performance within the small cap space is any indication of what may be on the horizon for the broader market, we may be on the path to renewed style leadership from value-oriented stocks. This chart highlights how the market leadership of style tends to be exhibited cyclically. For example, the pre-global financial crisis era was dominated by value-oriented companies, while investors have favored growth since 2008. Despite a recent reversal, history suggests that value companies have a long way to go to make up the relative trailing performance differential that is currently being exhibited. To that end, forecasting future style leadership is notoriously difficult. While higher valuation equities struggled during the first 2 months of the year and cheap stocks held up relatively well, that trend reversed in March. It seems as though investors are trying to determine the correct repricing of growth-oriented companies, which have thrived during the recent period of historically low interest rates. Higher rates going forward could lead to heightened volatility, particularly for more expensive areas of the market. U.S. equities continue to remain attractive relative to bonds due to a positive equity risk premium, which we'll touch on in a few slides. Risk to the domestic equity space remains prevalent and include the aforementioned increasingly hawkish spread. Thinking about risks that have developed across the pond during the quarter, U.S. stocks should be more insulated from geopolitical strife. However, there are certainly areas of the market that are more vulnerable than others. To that point, the technology sector of the S&P 500, for example, derives more than half of its revenue from non-U.S. sources, which could leave the space more vulnerable to future disruption overseas. Another potential risk to domestic stocks is the chance of a recession in the near future, as an inversion of the 2 and 10-year Treasury spread, like the one that took place earlier this year, has served as a reliable indicator of a downturn in the last several decades. That said, it should be noted that in the last 5 instances of such an inversion, the S&P 500 notched robust performance in the 500 days subsequent to the 210 spread turning negative. This should help alleviate potential investor concerns surrounding the yield curve, at least in the near term, and underscore the challenges of market timing. All else equal, value-style sectors may be primed to benefit from interest rate increases going forward. In the last 10 years, cyclical areas of the market like energy, financials, industrials, and materials have been more correlated with movements in the 10-year Treasury yield than more growth-oriented sectors of the market. Performance of some value-oriented sectors like utilities, on the other hand, have exhibited a negative relationship with interest rate movements in the last decade, likely due to the bond proxy nature of some of these spaces. Perhaps unsurprisingly, market volatility has been elevated in response to macroeconomic challenges and geopolitical tensions. During the first 3 months of 2022, the Russell 1000 index exhibited 31 instances of daily price movements that were 1% or greater in either direction. The index is on pace to eclipse these figures recorded in 2021 and 2020, when the benchmark notched 56 and 107 instances respectively. Despite the fact that the VIX retreated back to its long-term average by the end of March, we expect to see continued volatility in the market as the Fed attempts to put a lid on inflation. That said, market volatility can be a harbinger of opportunity for some investment styles. This chart highlights the dispersion between the daily leaders and laggards over a 21-day rolling period for both the Russell 1000 and Russell 2000 indices. The data suggest that current levels of dispersion are elevated relative to long-term averages. This could mean managers with a history of strong stock selection are now in a better environment to generate above benchmark returns. Higher yields and positive economic growth have historically benefited small cap value indices, which have a higher allocation to commodity price and interest rate sensitive areas of the market. For example, approximately 15% of the Russell 2000 Value Index is allocated to regional banks, which have earnings prospects directly correlated to interest rate movements. And about 10% of the index resides within the energy sector, whose constituents are largely benefiting from oil price inflation. The added benefits small cap value stocks have over other stocks within the U.S. equity space are attractive relative valuations, which can be seen in this table. Specifically, the Russell 2000 Value Index is currently trading at 12.1 times trailing earnings, which falls into the bottom decile of its historical range. Given higher levels of uncertainty in the market and elevated risks to the U.S. equity space, it is important to keep in mind that domestic stocks remain attractive relative to bonds given that yields remain low on a historical basis. That said, higher rates could lead to a narrower premium going forward, and we will continue to monitor risks and opportunities within the U.S. equity space to provide counsel to clients accordingly.
Hello, everyone. My name is David Hernandez, Senior Research Analyst at Market Associates, and I will be covering the non-U.S. equity section. Non-U.S. equities faced a cascade of headwinds in the first quarter, with Russia's invasion of Ukraine moving existing interest rates and inflation concerns from a moderate fear to a highly distressed fear. In the face of heightened geopolitical issues, we've seen inflation globally increase to levels that we have not seen over the last 20 years as energy, commodity, and food prices have risen rapidly. Cyclical sectors have been the dominant green shoots as the value trade carried into 2022, while long-duration growth stocks reprice in light of higher expected interest rates. On the coming slides, we'll discuss performance drivers for the first quarter, along with potential risk and opportunities to be mindful of as we move forward into the year. On a relative basis, international equities started off 2022 ahead of U.S. markets, with developed markets represented here by the MSCI EAFE index and emerging markets outpacing the S&P 500. Yet on February 24th, that trajectory shifted as Western countries levied financial sanctions against Russia and processed the broader implications of the Ukrainian war, particularly as it pertains to the economic linkage and trade relations with Russia. And we saw markets struggle with the shock of the war, coupled with record inflation, rising rate expectations, and slowing economic growth concerns. Developed markets slipped into negative territory, returning negative 5.4% in the first quarter. Emerging markets did even worse, returning negative 7% in the quarter, and developed small cap stocks underperformed developed large cap stocks, losing 8.5% in the first quarter. From a sector perspective, cyclicals were the top performers in the EFI index. Energy reigned supreme in terms of absolute return, posting a positive 17% return in the first quarter as integrated oil and E&P stocks rose on higher oil prices and tighter supply. The material sector was another positive for developed markets, posting a 3.4% return, and this group was aided by a sharp run-up in commodity prices that occurred globally. Within emerging markets, financials and materials fared the best for the quarter, up 5.7 and 3.2% respectively. Now, because of the West's response to the war, energy within emerging markets was a key laggard. This was largely due to the Russian exposure within the energy sector, as all Russian stocks were written to zero in the first quarter of 2022. Looking forward to the rest of the year, we need to acknowledge that there are some risks that we're keeping our eyes on. Now, during periods of market transition or extreme volatility, our experience has taught us that investors will make sudden shifts out of risky assets. From an asset allocation standpoint, that flight to quality tends to lead investors into overweighting their U.S. positions, as it is seen as a safer haven than non-U.S. markets. Coupled with growth factors trading lower in general, taking shelter by overweighting U.S. equities will likely be an added headwind for non-U.S. equity markets. Another risk to be mindful of is the secondary implications of the humanitarian crisis and global shock caused by Russia's invasion of Ukraine. This is the largest war in Europe since World War II, which has suddenly awakened governments to the urgent need of making their economies less reliant on oil and gas imports from Russia. Eurozone inflation surged to an all-time high of 7.5% in March, driven primarily by energy inflation. Energy prices were up 45% year over year, with dizzying jumps in natural gas, electricity, and oil. Global growth outlook, particularly for Europe, has also weakened and become more uncertain as the war pushes energy prices higher, dampens confidence, and affects global trade. At their March meeting, the ECB, European Central Bank, trimmed its baseline 2022 GDP growth forecast to 3.7% from 4.2% to account for the exceptional uncertainty that's been caused by the Ukraine crisis. Europe's fiscal titan, Germany, has substantial recession risk, with growing consensus forecasting contracting GDP growth for the first quarter after recording negative 0.3% in the fourth quarter. And as shown, Europe's consumer confidence and political uncertainty indicators are trending in a more negative way as the year-over-year change in European firms' earnings are also falling. On the positive side and our opportunity side, the sharp sell-off on growth stocks with expected rate hikes has shined a favorable outlook for the value style. January was one of the strongest value months in decades, with the EFI value exceeding the EFI growth index by 11.6%. That's the largest monthly differential in 47 years. And as shown for the total international market represented here by the MSCI ACWI ex-US index, value has outpaced growth across capitalizations on a trailing 1 year and a year-to-date basis, with developed markets pulling farther ahead of emerging markets in the first quarter. Additionally, there's a renewed case for a China bounce back, perhaps in the second half of the year. After hitting a record high in December 2020, forward and trailing price-to-earnings ratios for the MSCI China Index plummeted throughout 2021 on the news of sweeping regulatory changes for e-commerce, gaming, real estate, and private education industries. After the first quarter, valuations are now near 5-year lows, with markets further discounting Chinese stocks in response to China's zero COVID policy, along with further anticipated disruptions to the supply chain and lingering concerns over the real estate market. Faced with the likelihood of annual GDP growth below their 5.5% target, investors will be looking to China's central bank to begin easing, which could spur a bounce back in Chinese consumer and technology names. Let's wrap up the non-U.S. equities section by reviewing the opportunities and risk that we have highlighted. Now, we think there are a number of risks that serve as headwinds for non-U.S. equities over the coming quarters. In periods of heightened volatility, investors typically flock to U.S. equities at the expense of non-U.S. equities. Additionally, Europe is facing a challenging environment. That environment is putting downward pressure on economic activity. On the opportunity side, we think value stocks may have further runway from here, though slowing economic growth can dampen the cyclical outlook. Finally, we're looking for a China bounce back in the second half of 2022 as valuations have hit 5-year lows and the government positions to a more supportive stance both on monetary policy as well on the regulatory front.
Hi, my name is Chad Schaefer, and I will be covering the hedge fund section of this presentation. Hedge funds performed relatively well in the first quarter, as fixed income and equity indices pulled back amid increasing concerns that inflation, geopolitical tensions, and a hawkish Fed playing catch-up could trigger a recession in the U.S. The HFRI composite was down 80 basis points through March. Relative value strategies were positive, benefiting from heightened volatility. Merger arb strategies did well despite the M&A market slowing from last year's record pace, with a number of large and strategic deals announced in the quarter, and spreads reflecting the regulatory uncertainties in the market. Macro strategies led hedge fund results, up almost 7% year to date, with positive returns in each month during the quarter. Unsurprisingly, commodity strategies led that group, up 10.5% for the quarter. While macro and trend following strategies excelled amid the heightened market volatility, equity hedge funds underperformed the broader group for the quarter. The issues were generally on the long side, while short positions added value. In the next few slides, we'll look at how reduced exposures and an overweight to growth weighed on performance. While equity hedge funds initially held up well relative to the S&P 500, protecting capital in both January and in February, they trailed in the late March rally after reducing gross and net exposures. March was the largest month of tech selling in more than 10 years, partially offset by additions to energy and inflation-levered names. U.S. long-short net leverage finished the quarter at 45%, placing it in only the 14th percentile since 2010. As mentioned, weakness came mostly on the long side in equity long-short, with crowded longs trailing the long-only benchmark. Hedge funds have begun rotating out of these names, with exposure now at a 2-year low. In contrast, short positions have added meaningful alpha this year, with hedge funds adding to short positions year to date and moving out of ETFs in favor of single-name alpha shorts. Further, hedge fund overweights to more growth-oriented sectors weighed on performance, with rising inflation and interest rates impacting valuations. Fundamental growth funds underperformed fundamental value funds, with healthcare and technology funds both down over 7% each. In contrast, energy-focused funds rallied considerably, coinciding with rising commodity prices. Looking forward, we believe the opportunities for hedge funds outweigh the risks. While long-short equity has struggled more recently in a market heavily influenced by top-down factors and technical pressures, the opportunity set for bottoms-up stock picking on both the long and the short side has improved. Event-driven managers are well positioned, with corporate activity high and portfolios driven more by idiosyncratic events than market directionality. And while opportunities aren't as broad in credit, given tight spreads, rising rates, and a benign default environment, there are interesting pockets like structured credit, convertible arbitrage, and other relative value strategies. As mentioned, the opportunity for long-short stock picking has improved against increasing equity market dispersion. Following the GFC, low interest rates facilitated more than a decade of above-average returns and below-average dispersion in equity markets. Generally, when stocks move up and to the right together, it is harder for managers to add alpha via bottoms-up security selection, especially on the short side. Today, companies and management teams are navigating heightened inflation and higher rates in different ways, creating opportunities for stock pickers to add value. This opportunity is especially strong as we normalize out of the COVID pandemic. In addition to navigating inflation, rates, geopolitical tensions, and the possibility of recession, a number of sectors and industries are coming out of COVID either under-earning or over-earning their historical equilibrium. This adds a layer of complexity for companies, both internally in terms of balance sheet decisions and externally in terms of how accurately the street can model earnings, creating additional opportunities for good long-short equity managers to identify potential outperformers or underperformers.
Hi, I'm Josh Cabrera, Marquette Senior Research Analyst of Real Estate and Infrastructure. Commercial real estate performance hit historic highs in 2021 after a transitory dip during the pandemic, lending support to the overall resiliency across property types. However, inflationary concerns and the likelihood of multiple interest rate hikes this year may put downward pressure on valuations and an added reliance on income as the main driver of returns in the short term. One downstream effect of the accelerated recovery in the U.S. has been elevated inflation, as demand pushed against supply constraints amid geopolitical tensions. While persistent inflationary pressures may be an upcoming drag on the real estate market, commercial real estate should be a solid inflation hedge, providing risk-adjusted capital appreciation benefits and defensive cash flows. Institutional capital continues to be deployed into Odyssey funds at a rapid rate, with over $18 billion committed in 2021. With an abundance of available dry powder, investors are also capitalizing on favorable financing deals in attractive sectors and markets. 2022 is expected to be another strong year for multifamily performance and occupancy levels across the class and price point spectrum. Gateway growth markets should see rent growth well above their long-term averages amidst a tight housing supply, demographic tailwinds, and the broader economic recovery. In the near term, job growth and higher wages will support household formation, but the long-term housing shortage will fuel a multi-year runway for growth. Although the work-from-home dynamics has been a broad negative for future office demand, employers recognize that a physical office reinforces firm culture, drives collaboration, and enables professional growth. In addition, flight to quality patterns continue to lead to a wide divergence in space demand by building age and layout. Institutional investors will continue to analyze the risks and opportunities for portfolio growth going forward. Bolstered by a strong job market, the strength of the U.S. consumer, and the short-term immunity to the Russia-Ukraine crisis, commercial real estate should continue its accelerated pace in the coming year. As the Fed looks to raise rates as much as 6 times in 2022, cap rates across sectors may soon follow suit, following similar trajectories, forcing real estate investors to put an added emphasis on sustained NOI growth. Although inflationary increases have persisted longer than initially anticipated, monetary policy, along with favorable mark-to-market leasing structures in industrial and multifamily, should curtail the potential impact of higher rates in 2022. Despite the fact that the return to office and business travel were temporarily derailed by the surge in variant cases, as companies reassess their physical footprints and travel budgets, accelerated leasing velocity and strong employment growth should drive the gradual recovery going forward. And now, moving on to infrastructure. Despite the fact that performance continues to be lagged on a quarterly basis, infrastructure is shown to be a source of risk-adjusted returns, a portfolio diversifier, and a stable source for yield amidst an escalating Russia-Ukraine crisis and an inflationary environment. The Infrastructure Investment and Jobs Act, which was passed this past November, should lead to more non-traditional infrastructure investments, particularly in telecommunications and ESG-friendly power initiatives. The Act should align well with the decarbonization, digitalization, and decentralization themes in the coming decades. Reliance on non-traditional energy sources and the renewed focus on the transition towards cleaner, alternative energy options will foster the trend of decarbonization and digitization. As current geopolitical risks remain, the lasting impact of current supply-demand imbalances will force both the public and private sectors to accelerate efforts towards the transition towards cleaner energy projects. Looking ahead to the go-forward risks and opportunities for infrastructure. Institutional investors will continue to increase capital allocations towards infrastructure, promoting the shift towards smart technology, decarbonization, and ESG sustainability. In addition, investors will likely remain fixated on the Russia-Ukraine conflict, pending rate hikes, and the trends of rising inflation, as well as allocating capital resources to midstream energy companies and renewable-focused utility holdings. Finally, the alignment of government policies and the increased focus on future energy production and storage will present long-term growth opportunities for infrastructure, potentially offsetting any potential deal flow monopolization by the megafunds.
Hi, I'm Derek Schmidt, Marquette's Director of Private Equity, and I'll review the Q1 2022 private equity market environment. With Q3 2021 market performance just out last week, we can see private equity produce strong outperformance against a relatively flat quarter for the public markets, ahead of their Q4 pullback. While performance was strong globally across the private equity market, we continue to see venture capital leading the way with market-leading returns. Median North American private equity returns continue to outpace the Russell 3000 public market equivalent. We continue to see significant upside potential from manager selection, as the upper quartile and decile allow for significant alpha generation. It's been a strong decade for private equity, with losses mainly confined to the bottom decile funds. However, as market volatility and risk increase, we anticipate losses to occur across the bottom quartile of funds. The risk-return outlook continues to be favorable for private equity, with the opportunities outweighing the risks. But program construction and experience is increasingly important in today's market. The relative value opportunity continues to exist as private market transactions remain priced well below public market valuations. Small buyouts remain most attractive in our view due to the persistent inefficiencies with robust capital awaiting deployment within larger funds, providing attractive and efficient exit opportunities. For this same market positioning, the early-stage venture space remains attractive with innovation being constant and significant capital available at the later stages for successful venture-backed firms. However, we would caution the valuation pressures continue to mount across the market, and the public to private valuation spread is narrowing, as large private equity and venture capital valuations are most correlated with public market valuations. With more capital flowing into the private markets, we see performance pressures growing due to quality and operational experience differences and believe this could lead to increasing performance spread and greater level of losses across the 2020 to 2022 vintages. U.S. private equity fundraising bounced back in 2021, raising over $300 billion after a slow 2020, and is again off to a very strong start in 2022, as many strong performing and experienced managers are coming back to market quickly. One of the primary reasons for the previously mentioned strong fundraising environment was the record 2021 deployment across the U.S. private equity market, with over $1.2 trillion being deployed across over 8,000 transactions. The deployment was up 79% year over year, as there was a pent-up demand for transactions coming out of COVID. It is difficult to see the market continuing at this pace, and we would expect 2022 transactions to moderate to more recent levels of industry activity. The venture capital market shattered records in 2021 with a record number of deals and deployment. U.S. venture capital managers deployed nearly $330 billion, up 98% year over year, across more than 15,500 deals. This record deployment was driven by a significant amount of capital deployed across the later stages of the U.S. venture capital market, with the later stages alone eclipsing the previous overall deployment record for the industry by over 15%. So the opportunities within private equity remain attractive, but the overall market warrants caution. Looking back to 2021, fundraising environment and deployment levels were robust despite elevated valuations. Venture capital remained the best performing area of the market as the asset class expanded and institutionalized with a record level of capital being raised and deployed, supporting companies that remain private for longer. Looking ahead, we see pressures mounting with continued wage pressures, supply chain challenges, and rising debt costs. Public market pressures and volatility are likely to provide valuation pressures across the larger ends of the private equity and venture capital markets. With more capital continuing to flow into private equity, much of it into funds focused on the upper end of the market, we see continued opportunities to benefit from multiple expansion across early stage venture and small buyout exits, as demand remains robust for high-performing private companies.
I'm Brett Graffey, Senior Research Analyst at Marquette Associates, and I'll be reviewing the first quarter 2022 market environment for private credit. Reporting on a lag basis, private credit finished strong in the third quarter of 2021, exceeding all public fixed income and equity indices by over 100 basis points. Alternatively, over the 1 and 3 year periods, private credit has lagged most public equity indices and has performed in line with levered loans and exceeded the Barclays Agg Index. Over the 5 and 10 year time horizon, private credit has performed up to expectations, producing strong returns, exceeding most public fixed income indices, but lagging the general equity markets. Overall, the return and yield premium achieved by investing in private credit remains as a return driver and a risk mitigant for the asset class. While private credit as an asset class has grown significantly the past 10 years, and we continue to see new managers and strategies enter the marketplace, those dynamics have not seriously deteriorated the fundamentals of the private credit loan. The amount of debt at the company level has remained steady, and the average debt to EBITDA stands at 5.8 times, similar to what it was back in 2014. Alternatively, equity cushions have increased almost 25% since 2014, providing debt holders with more support in individual deals. These trends are likely to continue and represent a positive tailwind for the asset class. Sponsor-backed deals, meaning those companies who are owned by private equity managers, have continued to provide downside support through the most challenging markets. Looking at the worst period of the great financial crisis and the COVID pandemic, private equity-backed companies were nearly 50% less likely to default compared to non-private equity-backed companies. Sponsor-backed strategies provide investors with a strong core holding to an overall private credit portfolio, allowing investors to allocate to more tactical strategies as a satellite position. In 2021 and now in 2022, inflation has emerged as a top threat to investor portfolios and a threat to the market. Private credit provides a viable option to help investors mitigate the risk within their broader portfolio. Private credit offers protections against inflation. Returns are generated from interest rate that is based on a floating rate. The floating rate nature of these loans means that if inflation causes short-term interest rates to rise, investors can be protected. Floating rate loans are likely to outperform fixed rate bond allocations in a rising rate environment. Overall, private credit performance was strong through the third quarter 2021, and has performed up to expectations over the past decade. Most importantly, the asset class continues to provide itself as a value add to institutional portfolios. The need for private credit remains strong as companies, both private equity backed and non-private equity backed, are in need of capital to finance new acquisitions or to refinance existing debt, all against the backdrop of the lack of bank participation in the market. Being top of the capital structure and earning a yield above traditional fixed income remains a key selling point for current and prospective investors. While these factors will continue to drive the asset class and attract new capital and new market entrants, we believe the fundamentals will remain intact and see many benefits for investors to include private credit alongside their existing fixed income and equity portfolios.
We'd like to thank you for watching this video and hope it's been useful for you and your committees as you think about the second quarter of this year as well as the remainder of the year. For any clients, feel free to contact your consultant for more information. If you have specific research questions, you can email research5@marquetteassociates.com. If you have more broad Marquette-related questions, you can email marquettemarketing@marquetteassociates.com. Please visit our website for more publications, and you can subscribe to all of our research email alerts. You can also subscribe to our channel for new notifications of new videos. We'd like to thank you very much for spending some time with us today. We hope this has been a good use of your time, and please let us know how we can improve going forward. Thank you.